Hi, today we'll be walking through education on Yieldstreet's newest product lineup, Structured Notes, a potential portfolio enhancer. Structured Notes are hybrid securities that are issued as debt but track the performance of an underlying stock. Structured Notes have four main components. First is the underlying, which is a single reference stock that performance is measured against. The second is the maturity, which is the time period a structured note is expected to be held before principal payments are expected. The third is protection, which is the downside protection that a structured note offers before performance may be impacted. And finally, it's the coupon, which is the annual income that is expected to be received if the structured note is performing. To bring structured notes to life, let's focus on the following illustrative example and the four components we just discussed. For this example, let's use MasterCard, ticker MA, to be the underlying stock. Performance of MasterCard will be measured versus its strike price, which we'll get into later. The maturity of the structured note will be 18 months, consisting of 6 quarterly observation periods. The downside protection will be 25%. And finally, the coupon will be 12% annualized, consisting of 4 quarterly payments of 3%, so long as the performance criteria is met. As you can see on the screen, at observation period 0, the structured note is issued. For performance, it will be measured relative to its strike price. For this example, we can say the strike price is $300 and the relative performance at time of strike is 0%. The orange line tracking across the bottom of the chart is the downside protection value. The dark blue bars are the underlying performance relative to the strike price on each observation date. Both the strike price and observation price for each quarter are measured at the close of trading on these days. The light blue bars is the coupon value of the structured note. At the end of observation period 1, the underlying stock has increased by 2%, which is above the downside protection value, so investors would receive their 3% quarterly coupon for this payment. At the end of observation period 2 and 3, the underlying stock price increased by 5 and 9% respectively from the strike price, which are above the downside protection value, so investors would receive their 3% quarterly coupon for both periods. Fast forward to the end of observation period 4, we can see that the underlying stock has actually now declined negative 15% from the strike price, but it's still above the downside protection value, so investors would receive their 3% quarterly coupon for the period. Now, let's fast forward to the end of observation period 5, and we can see that the underlying stock has actually continued to decline even further and is now down negative 27% from the strike price. Since it's now below the downside protection value, the investors would not receive their quarterly coupon for this period. Now, as we get to the final observation period, period 6, the underlying stock has actually recovered and is down only negative 5% from the strike price. Since it's above the downside protection value, investors would receive their 3% quarterly coupon, and since it's the final observation period, investors would also receive their full principal back. However, there are other scenarios, and so for this, let's instead assume an alternative scenario for the final observation period. In this scenario, the underlying stock price instead continued to decline from period 5 and is now down over 30% from the strike price. Since it's now down below the downside protection value, investors would not receive their quarterly coupon. And since this is the final observation period, investors would receive only 70% of their principal, which is the remaining value after the performance of the underlying is applied to their principal balance. There is also another scenario that is possible, and that is one where the structured note may be called prior to maturity. Structured notes are typically always callable at the discretion of the issuing bank. Structured notes are often called when performance of the underlying is relatively strong and usually close to or above 10% from the strike price. In this scenario, investors would receive their full principal back at time of call. Hopefully, that illustrative example helped everyone understand how structured notes work. And structured notes have multiple potential benefits. The first are their predefined outcomes. Investors know the performance of their structured notes and their expected coupons and their downside protection. Structured notes also help protect against losses while also providing a target level of income. Structured notes can also help improve the risk-return profile of your overall portfolio. And finally, structured notes, considering where they sit between stocks and bonds on the risk-return spectrum, are typically funded from the equity portion of one's portfolio. Now, let's take a look at how structured notes can help you create a more efficient portfolio by improving the risk-return profile. Let's again use the MasterCard structured note example. As a reminder, the reference stock is MasterCard, the maturity is 18 months, the downside protection value is 25%, and the annual coupon is 12%. For this, let's assume there are two portfolios. Portfolio 1 that holds 100% MasterCard stock, and Portfolio 2 that holds 50% MasterCard stock and 50% in the MasterCard structured note. In the chart on the lower left, we can see scenario 1, where after 18 months, MasterCard stock has appreciated by 20%. Portfolio 1 has achieved 20% returns coming entirely from the performance of MasterCard stock. Portfolio 2 has returned 19%, 20% from its holding in MasterCard stock, and 18% in its holding of the MasterCard structured note. The 18% from the structured note comes from each quarterly coupon from the 6 periods over 1.5 years. In scenario 2 on the right, this time, MasterCard has lost 20% after 18 months. Portfolio 1 has lost all 20% since it owned 100% of MasterCard stock. However, Portfolio 2 lost only 1%. Portfolio 2's holding of MasterCard did also decline by 20%, but its MasterCard structured note returned 18% as it received each quarterly coupon since MasterCard did not decline below its downside protection on any of the observation dates. Thank you for taking the time to learn more about structured notes, and for more information, please make sure to check out Yieldstreet.com.